Time now for our Muni Moment, and according to data compiled by Bloomberg, U.S. states and cities are set to boost borrowing to the highest level in more than a year, and that's putting pressure on an already weak market, but potentially enticing investors. Joining us now for more insight on munis is Chip Hughey. He is Managing Director of Fixed Income over at Truist. And Chip, when you think about how supply-starved the muni market has been, what would an influx of bonds look like?
Yeah, thanks, Katie. Thank you, Romaine, for having me. We have seen an effect from that influx of supply. So we're up to about 17 billion in new muni supply expected over the next month or so, and that is having an effect on muni to treasury ratio. So you've seen muni yields rise a bit more than we've seen over the course of the past several months. That's actually raised those ratios to a little bit more attractive levels. We are in a kind of a seasonal period right now where muni issuance tends to be quite a bit quicker in October. Once you get more towards the holiday season, that tends to slow down a bit.
Well, when you think about Treasury yields kind of maybe driving muni yields here, and you think about what's driving Treasury yields, it all seems specific to the Treasury market, some of those supply concerns specifically in the Treasury market. When you think about that in relation to munis and this rise in yields that you've seen, is that a buying opportunity?
Yeah, I think that because of the volatility we're seeing, it's easy to lose sight of just how elevated municipal yields are, especially if you think about them only in the context of those ratios. In the front end of the curve, AAA muni yields are as high as they've been since 2007, 2008. Out longer, it's more in the 2013 to 2014 year range where you go back and where we saw yields this high. So that has dramatically improved the forward return outlook for high-grade fixed income. So a lot of that move has been really driven by the Treasury market, factors away from the municipal market. I mean, you think about the Fed's higher for longer pledge, a stronger U.S. Treasury debt issuance, and also just resilient economic data that's delaying those recession calls or slowdown calls. All of that's affecting Treasury yields, and that's filtering into virtually all high-quality fixed income, including municipals.
There's been a lot of talk, though, I guess, about where yields go next, or maybe the possibility, Chip, that they don't go anywhere, that they just stay elevated here. Let's say that this is the new normal. Let's say a 5% world, just to take a round number here. How much, if at all, does that change the fundamentals for you in how you assess what ends up being a good buy and what's not?
Yeah, when we look at what the Fed is doing, I think the Fed is actively looking for that off-ramp to end its hiking cycle. So that would suggest that we are close to, if not, or at the peak in yields towards the front end of the curve. And what you typically see is after the last Fed rate hike, what tends to happen is high-quality fixed income yields tend to fall over the subsequent 6 months. On average, the 10-year U.S. Treasury yield falls by between 125 to 150 basis points over the course of the next 5 to 6 months. So we just need a little bit more certainty from the Fed that the Fed is completing its hiking cycle, that inflation is cooperating, and maybe some cooling on the labor markets. And then I think that you will see intermediate and longer yields try to get into that peaking process as well. And that would filter into places like high-grade municipals.
I'm curious, for investors who are maybe looking to enter this space or at least to expand their allocations to it, I mean, how do you sort of look at the potential returns, whether you're looking at the yield or even the price return? Do you look at it right now basically at an absolute level, basically just put that muni issue into a vacuum and say, okay, here's what I get? Or is there something attractive that you can discern by looking at its relative valuation to something like Treasuries?
Yeah. I think one way to approach the market right now and where yields currently are is really through kind of a barbelled approach. So some exposure to those really elevated, attractive, and productive yields that you see in the front end of the curve. That's producing some of the highest income levels that we have seen in, call it, 16 or 17 years. So that's very impactful for portfolio returns. Also, combining that with some exposure out longer as well, that would not only is it generating some very attractive yields, but would benefit from declining interest rates if activity slows. Typically, you see yields fall in that context. That would generate positive price performance on top of that. I will say that the front end of the municipal curve is slightly expensive right now, or you could say very expensive. So for some portfolios, actually in the very shortest regions of the curve, like in the first year or so, Treasuries may actually make more sense than municipals, but municipals become much more attractive on a relative basis as you do move out the curve from there.